Everyone watches the stock market, but the world's biggest fortunes are often built long before a company ever reaches the stock exchange. Finance isn't one market, it's two completely different worlds. Public markets, where everyone trades, and private markets where deals are negotiated behind closed doors. Public markets feel comfortable because everything is visible. Prices update instantly, disclosures are public, and millions of investors share the same information. But transparency comes with a cost. When everyone sees the same information, genuine investment opportunities disappear incredibly fast. By the time an opportunity appears on a stock ticker, much of its value has already been negotiated privately through financing, ownership, and capital structure decisions. Private markets don't operate through exchanges. Every transaction is custom-built, with terms negotiated directly between investors and businesses. Instead of accepting a market price, private investors negotiate pricing, collateral, covenants, and protections before committing capital. Ironically, private markets create opportunity precisely because they are less efficient. Information isn't equally distributed, and access is limited. In private markets, your returns depend less on reacting to headlines and more on gaining access to the right relationships, networks, and opportunities. Public markets excel at measuring performance. They tell investors what assets are worth today, but not necessarily how tomorrow's value will be created. Unlike public markets, private markets don't just measure performance. Investors shape outcomes before the market ever assigns a price. One of the biggest advantages in private investing is choosing where you sit in the capital structure, balancing risk, protection, and potential return. Many of the most profitable moments never appear on financial television. They're negotiated quietly through restructurings, refinancings, acquisitions, and recap. Business operators often recognize opportunities long before investors do, because they experience real-world challenges before markets react. Institutional investors increasingly look beyond benchmarks, searching for negotiated opportunities that aren't driven by daily market volatility. For many sophisticated investors, the question is no longer which ETF to buy. It's who has access to opportunities that never become publicly available. Instead of asking what's trading today, experienced private investors ask a different question. What deals are being negotiated right now? Private credit brings this philosophy into practice by allowing investors to negotiate lending terms, collateral, covenants, and downside protection before capital is deployed. The biggest divide in investing isn't growth versus value or active versus passive. It's understanding the difference between observing prices and helping create them. If your entire investment process revolves around what appears on a screen, you may be missing where wealth is actually constructed.